balance sheet. This is it, guys. This is where the game gets involved. But thank God it's going to be ridiculously easy. This video is going to be about the balance sheet and just how easy it is to understand if you try to look at it in ways that make sense to you. And that's all we're going to focus on. I'm not going to give you a definition from Wikipedia or from the dictionary or from, Mount Olympus. I'm just going to talk about what the balance sheet involves, and that's it. And I promise, if you just follow and try to use the exact vernacular that I use to describe this, you're at least going to come away with a strong understanding of the balance sheet. So to start with, the balance sheet just records the status of a company at a certain period in time. A specific point in time. All right? So at the very beginning of the month, what does the company have and how did the company pay for it? If you have to write that down, write it down. But that's it. The balance sheet just wants to know, what does the company have and how did it pay for it? So what does the company have? When we described accounting before and we talked about the assumptions, we said that we're only going to detail the things that have economic value, so it's a resource that we can use, and it has to have some monetary value as well. So whatever it is that we're able to use has to have a monetary value attached to it. So some examples of assets, we'll say land, we'll say equipment, we'll say some supplies, we said equipment already, but equipment one more time, why not? Have as much equipment as possible. And then cash, so those are just some examples of assets, but I am being very stern here. Just imagine a very angry face, except I'm not going to show my face here because I'm uncomfortable with my face being on camera, but just picture the most angry Darth Vader looking face you could possibly imagine. Do not say you own the assets. Just say your assets are the resources that you're able to use to be productive for the company, but you just have them. The things that you have. Resources that the company has in its possession. So we're going to attach and never, ever, ever separate, except that I will because, I'm not going to keep them together forever. But in your mind, they should be glued together. They're just resources that the company has. And why do I emphasize have so much? And why is my Darth Vader face saying never say you own it? Because that's what this right side of the equation is about. It's how did we actually pay for what we have. So let's take, for example, before we go any further, just to cement it in your head. And don't worry, I'm going to give you examples of assets, and we're going to try and break down exactly what they are. And eventually, you could just go all willy-nilly and just find assets everywhere. But let's take your most prized possession. I'm going to pretend that it's a car. It should be your family. It should be love. That's what your most prized possession should be. But let's pretend right now it's a car that's sitting in your driveway. So let's say you look outside. Please pretend that you have a vehicle. And don't be cynical and go, I don't have a car, I can't do this. Just pretend you have a car and it's in your driveway. But you finance this car. The car is worth $10,000. So that's the first step with the assets that we have. They have to have economic value to us. They're resources, so they're going to be productive for us and help us be successful. But in the beginning, I said, for a business, I want you to just see money. So this is where it begins. Everything that the company has, I don't want you to see the object. I want you to see the monetary value. So let's pretend this car outside your driveway is $10,000. That's what it's worth. That's what you would pay for it. So Toyota makes a car, and you send them off $10,000. So now you have it. You don't see a red Toyota. All you see is $10,000 bills that just transform like Optimus Prime and turn into a vehicle. But there's no paint job on it. You still see, George Washington all over the place and the number 1 all over the place because you still see dollar bills. From now on, every single asset, everything you see in a company, the inventory, land, I don't want you to see land and inventory. I want you to actually just see the monetary value. So that's it. The things that they have the things the company has that has monetary value. But how did we pay for it? We see $10,000 in singles that transform into a car, but where did the money come from? How much of that $10,000 do we actually own? That's the equity. So usually, especially in the United States, you put down a small payment, which I don't know how wise that is, but it is what it is. So you put down $10,000 for the vehicle, you own, you have a claim. We remember for the car that we have in our driveway, we see $10,000 bills. So we have a claim to $1,000 out of that $10,000, and then we borrow the other $9,000. So for our liabilities, that's what we owe. We owe to our creditors, to our suppliers. Instead of paying for the things we have, we decide to purchase on credit. And our financial claim to what we have is our equity, what we actually own. Okay, so let's just go back to our story in the vehicle. The reason I want you to never ever say that you own the assets is because if you think about that car outside, if you financed $9,000 out of the $10,000, do you really feel like you own it? If you miss a payment, isn't the bank just going to come and repossess your car? And it's not going to be there anymore. You're not going to go to the judge and say, hey, it's still my vehicle. No, they technically own it. So you have the car in the driveway. Companies have assets. But how did we get those assets? All right? How much of the money that we see, so your supplies, inventory, land, the equipment, all the property that's owned for the company, don't see them as their physical representation, see the monetary value. Just see walking piles of cash everywhere and think, where did that money come from? Do we own it? Do we own that money? Or did it come from a bank? Do we owe that money? Are we going to be paying some interest expense? So that's all the balance sheet is about. It's what we have and how did we pay for what we have. All right, so it looks like the own here has been left out, which again, that's just symbolic. That's just nature doing its thing, because it looks like a lot of people just like to actually leverage at this point, which we'll talk about later. But let's bring the owning into the fold here, and that's it. That's what the balance sheet is all about. The things we have and how did we pay for it. So if it's $10,000, how much of the $10,000 do we own? That's your equity. How much of it do we owe? That's your total liabilities. And what a company is going to do is it's going to mash together every single thing that it has, and it's going to eventually divvy out, okay, we owe this amount. The rest is what we actually own. And usually this owner's equity people will see as residual, because if all of a sudden, since you're highly leveraged here, you borrowed $9,000 and you only own $1,000, all of a sudden you can't keep up with your payments, the bank is going to have a claim on the asset, but they don't want the car. It wasn't their choice. They don't need vehicles. So if the company is having some financial trouble, what's going to happen is that the company is going to have to go through bankruptcy, and the courts are going to liquidate everything that the company has so that it can pay back what it owes. So if there's anything left over, let's say the vehicle, it depreciates all of a sudden. You had it and it was worth $10,000, but now it's only worth $8,000. So it looks like and you haven't made any payments to the bank. So it looks like the bank over here, the creditor, is going to lose out on about $1,000. Okay, so right now the asset's only worth $8,000. It's liquidated to get all the money back for what you had, and they pay back what you owe. So it looks like the bank took a bad risk giving you the money. There, you were way too leveraged here, and you end up with nothing. You lost the $1,000 that you invested, and it looks like you lost the bank as well $1,000, and that's all it really is. That's all the balance sheet is. It's just a measure of what you have and how you paid for what you have. So it all boils down to this equation here. A equals L plus E. I don't know what you do. I don't know what your ritual is to help you remember things. If you stare at it, just meditate. Yes, you know what? That's some advice for you. Meditate. But just look at this. A equals L plus E. The things we have, business is all about money, so where did we get the money to pay for what we have? Did we borrow a bunch of money, our liabilities, or did we use some of our own money? Did we actually have a claim to the assets? And that's it. That's how I want you to start looking at accounting, okay? Just make it normal to you. Just from now on, take that most prized possession you have, think of the monetary value of it, and think, how did I pay for it? Do I own all of it? is 100% equity, or do I owe a bunch of money for it? And that's it. That's all accounting is. Don't make it more complicated for yourself. Assets equal total liabilities and equity. It's what we have, the things a company has, the monetary value of it especially, is going to equal how much we owe and how much of it we actually own, which again equals the A equals L plus E. Look, I even did it again by accident, of course, but whatever, being wasteful, I'm just going to use them both. A equals L plus E twice. It's the start, the balance sheet, a specific point in time. The things we have equals what we owe for it plus how much of it we actually own. And I'm going to make more videos that actually go in depth.